These markets in red, prices are already way too high above inflation, above wages, and if we get increasing interest rates, which is definitely going to happen in a sustained inflationary environment, it's going to crash these markets in red. Inflation is raging right now, a plus 6.8% increase in inflation in the consumer price index, according to brand new data that just came out today from the Bureau of Labor Statistics. This, of course, is bad news for the American consumer, as it means the price of goods and services in the economy is skyrocketing, the highest that we've seen in, get this, nearly 40 years. However, could these red-hot inflation readings be preempting a big deflationary episode, a big deflationary crash? That's what I'm going to talk about in this video, and specifically apply it to the U.S. housing market. Show you the cities around America that would benefit most from an inflationary environment, as well as the ones that would benefit most from a deflationary environment. Because if you're a home buyer, real estate investor right now at the end of 2021, entering 2022, you need to be paying attention to inflation, because it's going to have a huge impact on whether your home prices will be going up or down over the next couple years. Without further ado, let's get into the data. So we're going to start things off by taking a look at the year-over-year percentage increases in inflation going back 10 years, and you can see the readings that we're seeing over the last couple months in America are red hot. This 6.8, 6.9% level that we just experienced in November, according to the Bureau of Labor Statistics, is by far the highest that we've seen in the last decade. I mean, take a look. We see 1%, 2%, 3%, all of a sudden now 6 to 7% increases in the cost of goods and services. And many people are now concerned that this is just the start of things to come, that America is going to enter another long-term inflationary cycle, just like we saw in the 1970s, where you can see from the early 70s to the early 80s, inflation in America was red hot. We're talking 10%, 12%. 13%, 14% for the better part of a decade. Now, as you can see here, our 6.9%, we are not even kind of in the realm yet of anything like we experienced in the 70s. Right now, we're actually probably more similar to what we saw in the late 2000s, around 2008. We had a pretty big inflation spike. We also had a big inflation spike in 1990, as well as a big inflation spike in 1948 and 1951. These other inflation spikes in the early 50s, early 90s, and the mid-2000s all subsided. They were transitory. And so the key question here is this inflation we're seeing today in the end of 2021 transitory? Are we going to see it start to go down over the next 12 months? Or are we going to go to this 1970s period of hyperinflation where we just see 10% a year, 12% a year for the better part of a decade? Answering this question is going to be very important for you, whether you're someone who's a home buyer, real estate investor, or maybe you invest in the stock market or cryptocurrency. You need to understand what the likely future direction of inflation and interest rates is to make a more educated decision about your investment. Now, one of the things that looking at this overall inflation level hides is that there's big differences in how the costs of goods and services throughout the economy are changing. That's right. There's certain goods which are going way up in price and are really pulling that inflation number up. Meanwhile, there's other services and goods that really aren't going up so much in price. And that's what you can see represented on this graph, where we're showing the year-over-year percentage increase in consumer prices broken down into the 7 main components of inflation, 7 main components of things that you and me buy every single day. One would be energy, another would be durable goods like cars and appliances, another would be food, another would be clothes and apparel, shelter and rent, education, and medical care. And what you can see is there's a big difference in how much the cost of these things has gone up over the last year. Energy, the cost of gas, the cost of fuel, heating oil, natural gas is up 33% year over year. Quick 10-second commercial here, everyone. If you're enjoying the data in this video and you want to see more of it going forward, there's an easy way to do that. Just smash the like button into oblivion. When you do that, it gets this video out to more people, and I can produce more of this content on inflation in the U.S. housing market into the future. And it's clearly the biggest thing propelling this overall inflation figure of 6.8%, the yellow dotted line, higher. Now, the inflation figures that I'm showing you include that energy figure, include gas and oil, but often you'll see CPI figures reported that exclude energy. And the reason they do that is because energy prices can be very volatile, which you can see on this graph where we're looking at the year-over-year percentage change in these various components in inflation over time. Food, shelter, medical care, you can see are fairly stable, but then energy, this yellow line, is all over the map. Back in 2011, it was up by 22%. Then by 2015, it was down by 20%. Then it was up by 15% in 2017. Then it was down by 17% in April 2020 when the pandemic hit. Now it's up 33%. And so while energy prices today are really pulling inflation up, really hurting Americans' wallets, especially at the gas pump, these energy prices might not last. Like, they could start going down significantly over the next couple months and lower the overall inflation rate. In fact, we've seen the price of a barrel of oil decline by roughly 10% over the last 2 to 3 weeks. So if that holds, it's very likely that the December inflation readings are going to look lower just because the price of oil and gas went down. And this is why it's important to maintain perspective about this inflation. On one hand, yes, it is very bad and it is very serious, and it's a big problem for society and American consumers. There's a reason that 70% of Americans, according to the Fannie Mae Housing Survey, think the economy is going in the wrong direction, and that's because we all hate inflation. However, we should be careful about predicting that this inflationary spike is going to turn into another 1970s style inflation, because we need more than 6 months of inflationary pressures from energy primarily to call this long-term inflation. I would say right now this inflationary spike looks more like 2008, 1990, or 1951, where very shortly thereafter we had a decline in inflation and even deflation in certain circumstances. And this is a big question for the US housing market overall, because right now in America, home prices adjusted for inflation are at all-time highs. As you can see on this graph, the Case-Shiller Home Price Index adjusted for inflation is at an all-time high today, even higher than it was back in 2006. And so that means with all the inflation we've already really seen, home prices are already still at an all-time high level, which means that to justify today's home prices, we're going to need to see not just 6 months of high inflation, we're going to need to see these inflation readings of plus 6, 7%. We're going to need to see them continue for the next 3, 4, 5 years if we want to see that inflation-adjusted home price figure go down. If long-term inflation doesn't happen, which I don't think it's clear that it will, we are most certainly in a big housing bubble right now because Americans cannot afford today's prices and mortgage payments. But say we do have long-term inflation. Say this 6, 7% CPI increase keeps raging. Say the energy costs stay high. Say rent keeps going up. The cost of food stays where it is, keeps going up. 6, 7%. Say we keep that. That's going to make a very interesting housing market because I believe in that environment, say a rampant 7% per year inflationary environment for 5 years, something kind of similar to the 1970s, will make certain cities in the US housing market a good buy. It'll make other cities a very bad buy. And you can see that represented on this map where we're comparing the top 500 housing markets in America by a key metric I call value to earnings ratio, which divides the typical home price by the annual earnings of the average worker. And this is how it's going to go. If we get sustained long-term inflation, interest rates are going to go up for sure. The Fed is already tapering their QE. They're already buying fewer treasuries and mortgage-backed securities. They've announced that they're going to likely speed up that taper. That's going to push interest rates up. Additionally, the Fed has also come out and said in their meeting minutes that they might have to hike interest rates sooner than they thought. And right now, betting markets are predicting 3 interest rate hikes on the short-term interest rate in the US in 2022. This is going to push interest and mortgage rates up, and that's going to be very bad for certain cities on the map that we just looked at. A high inflation environment coupled with rising interest rates will absolutely crush the markets in red. These are the places that are extremely expensive for Americans to buy a home, where value to earnings ratios are very, very high. Places like Los Angeles, where the typical home price is $851,000 compared to $61,000 typical annual earnings. That's a 14x value to earnings ratio. LA is going to get crushed. San Francisco, with a 16x value to earnings ratio, is going to get crushed. Boise, Idaho, at an 11x is going to get crushed. Salt Lake at a 9.7 is going to get crushed. Denver at a 9.5 is going to get crushed. Austin at 9.4 is going to get crushed. Here's why. When interest rates go up, that's going to increase mortgage rates and mortgage payments. That's going to make these markets in red even more unaffordable, where people already are priced out of places like LA, Salt Lake, Austin, San Francisco, and Seattle. People are already priced out. They can't afford the down payments. They can't afford the mortgage payments. Well, if interest rates and mortgage rates start going up even more, that's going to make these markets more unaffordable, and it's going to basically crash demand in home sales. Meanwhile, these areas in blue are going to be much more insulated because home prices and mortgage payments are much more linked to what people make throughout much of the Midwest and the Mid-South. These areas in blue, a place like Oklahoma City, the typical home price is $192,000 compared to earnings of $46,000, only 4 times prices are only 4 times what people make. In Pittsburgh, the typical home price is $200,000, only 4.2 times the average earnings. And so an increase in inflation and interest rates isn't going to be nearly as devastating to those markets like Pittsburgh and Oklahoma City, quite simply because locals there can still afford homes. They can still afford the down payments. They can still afford the mortgage payments. So inflation actually might be good for those cities in blue. It might increase the value of real estate. It might actually help out those local housing markets. And this is the take on inflation that I don't think people in the housing market and real estate properly understand. Inflation is not going to be good for all of the U.S. housing market. It's only going to be a positive or a benefit for markets that are already affordable, because these markets can grow with inflation. These markets in red, prices are already way too high above inflation, above wages, and if we get increasing interest rates, which is definitely going to happen in a sustained inflationary environment, it's going to crash these markets in red. And so to put a bow on this, I think there's 4 main conclusions from this video. Number 1, yes, the inflationary pressures we're seeing in America right now are very high. They're at a 40-year high. It's a serious issue for U.S. consumers. Number 2, energy and durable goods are the primary drivers of this inflation, pulling that number up. Energy is up 33%, durable goods are up 15% year over year. The other main components of inflation aren't rising as much. Number 3, whether we're going to actually enter a sustained long-term inflationary environment like we did in the 1970s is unclear at this point. It could happen, it couldn't happen. The U.S. bond market right now does not think it's going to happen, given that Treasury yields actually went down today. But other people seem to be convinced that we are going to enter a long-term inflationary environment. I'm not sure actually what the right answer is. Both are a possibility. However, if we do enter that long-term sustained inflationary environment where interest rates rise, it's going to really hurt housing markets where prices are way above wages. Those markets in red, they're going to suffer immensely with increasing mortgage rates, which is going to basically crash all the demand in these markets. Meanwhile, cities where prices are more linked to wages and there's more affordability, they actually might do well. They're going to do better in an inflationary environment. All right, guys, I hope you enjoyed the data in this video. If you appreciated the content, just please make sure to smash that like button. Additionally, become a subscriber. I come out with 3 to 4 of these data-driven videos per week. I give you insights on this channel that you're not going to see anyplace else. All right, everyone, until next time, this is Nick from Reventure Consulting, signing off.